The oil market in recent years has been primarily focused on supply situations among OPEC countries, Russia, and the United States. Today, however, it's becoming clear that the outlook for production in China may also play a big role in the pricing of crude oil going forward. The big producer war and market share war of recent years that drove the oil price way down was primarily driven by OPEC. And over the last year or so, however, that's turned. We've seen the price of oil double off the bottom as OPEC has been trying to, at least they had been talking about reining in production while ramping it up. But at least the December deal appears to be holding. The Russia appears to be cutting back. Saudi Arabia, Iraq, Kuwait, a lot of the big OPEC countries have been talking about, appear to be delivering on their commitment to cut production. This has helped to put a floor underneath the price of oil. Going forward, there appeared to be some headwinds of at what price does the U.S. shale production start to come back online, and could that weigh on prices going forward? However, a new player in this situation and a new variable has entered today with talk that China's oil production is stagnating and that China's oil production could drop 7% over the next 4 years or so. The issue there is that China has a lot of aging oil fields. Exploration has not been delivered enough results to keep up to offset the natural declines in Chinese oil fields. So what we're seeing is that China's oil production could decline. That could offset some of the increases that we're seeing elsewhere and continue to support the oil market. So what are we seeing now? We're seeing that as, of course, the OPEC and Russia and other countries work their way towards a deal, we've seen a general uptrend in the crude oil price since summer. More recently, we've seen that previously there had been a range for WTI between about 40 and 50. That has since moved up to the 50 to 54, 55 range, where RSI is still showing range-bound action here, but it's also showing by holding these bounces up from just below 50 is also showing that the underlying uptrend remains intact for WTI crude oil. If we were to get a breakout here on WTI, you could probably see a move up into the 55 initial round number resistance and then the 57, 58 area, similar to what we've seen previously with a crude oil Brent, where Brent had been trading 45 to 53, and then it's moved up into the 53 to 58 area, 57, let's call it. Next measured resistance for that is 61. A breakout could bring the 60 round number into play. So we're seeing here a little bit of weakening in upward momentum short term for Brent, but overall the underlying uptrend remains intact. So with the crude oil market, we're likely to continue to see trading short term off of things like U.S. inventories, but overall longer term though, as OPEC continues to cut production, as China's production declines naturally, and as OPEC, if Russia also puts a lid on its production, and the U.S. is slow to ramp up its production, could support continued prices. If U.S. production ramps up more quickly, then that could be an issue. There is talk of more investment in the U.S. this year in oil field capital expense, but remember that's coming off a very, very low base. It's still much lower than it was running a few years ago. I've been watching the drill rig count. Even though drill rigs are increasing as they do every winter, they're still running below where they were a year ago. So even though there's a potential for some improvement in the U.S., it doesn't seem huge yet, but certainly the kind of thing we want to continue to keep an eye on, and that could drive trading action in the weeks and months to come.